25%. That is the market's current bet the Fed hikes on September 16th. 3 weeks ago, that bet was 60%. It collapsed. If you carry a mortgage, a credit card, or a savings account, this one announcement moves your money. So I ran 3 rate-sensitive ETFs through the KRONOS AI model. What it sees next is not what the headlines say. Before the numbers, here is the lens. Every figure in this video is a probability, not a prediction. A 24-cent contract means the crowd thinks there is roughly a 1 in 4 chance of a hike. So compare 3 sources and watch where they agree. The prediction market, the futures market, and the dot plot. When all 3 point the same way, the signal is strong. When they disagree, that gap is where the real story hides. And remember, the Fed is not a coin. In July, 9 members voted to hold. 3 voted to hike. The odds are a bet on the future, not the future itself. Every number in this video gets read through that lens. Here is the setup. The September meeting runs the 15th and 16th. Decision day, the 16th, 2 p.m. Eastern. It is a projections meeting, which means the Fed publishes the dot plot, each member's personal forecast for where rates go next. The target rate has sat at 3.5 to 3.75% since December. 9 months frozen. This chart is that flat line. And the question is whether September finally breaks it. A quarter-point hike would push the target to 3.75. That single number is the whole debate. Now watch what the odds did. Early August, the market priced a hike at 60%. By August 12th, the futures market had it at 38. August 14th, the rate hike trade collapsed, 25. Today the prediction markets trade the hike at 24 cents. 3 weeks, and the market cut its own bet by more than half. That is not fickleness. That is the market reacting to data in real time, the moment each number lands on the tape. Here's what killed it. July inflation cooled. Consumer prices rose 3.4% over the past year, down from 3.5. Core inflation, which strips out food and energy, sits at 2.5%. Producer prices did not move in July at all, and retail sales fell 0.6%, the biggest drop in 14 months. Prices cooling, the pipeline flat, the consumer pulling back. That is not a data set that demands a hike. The market read it instantly, and the odds followed. And the long end is sending its own message. The 30-year Treasury yield is at 5.24%, a 19-year high. The average 30-year mortgage sits at 6.69%, the highest in a year. The long bond is not panicking about a hike. It is panicking about something bigger. Government borrowing, term premium, or the simple fact that investors demand more to hold longer money. 2 numbers, both climbing, and both landing directly in the cost of your housing. Here is where it hits your wallet. The best high-yield savings accounts pay about 3.7% right now. The average credit card charges 21.52%. One rate grows your money. The other eats it. If the Fed holds, that gap stays. If the Fed hikes, the card rate moves first. Most cards adjust within 2 billing cycles. A quarter point on a $7,500 balance is about $19 a year. On $10,000 at the average card rate, interest alone tops $2,000 a year. The gap is the real story of your personal finances. The committee is not a monolith. In July, the vote was 9-3 to hold. 3 members, Cleveland, Minneapolis, Dallas, wanted a quarter-point hike right then. That is the most open dissent in years, and it is the single best hint about September. When a third of the room votes against the chair, the next meeting is a real contest, not a formality. The hold is favored. The hike is alive. I ran 3 rate-sensitive ETFs through the KRONOS AI model. 120 days of history, 30 days ahead. First, the long bond. TLT, the 20-plus year Treasury ETF, at $82.04 today. KRONOS projects $86.48 in 30 days, plus 5.4%. The range runs $81.90 to $86.69. The model is betting the long bond rallies into the fall. The market's own read that the worst of the rate shock is behind us, or at least that the Fed is done pushing. Now the short end. SHI, the 1 to 3 year Treasury ETF, at $82 flat. KRONOS sees $81.37 in 30 days, minus 0.8%. The range is narrow, 81.31 to 82.10. That flatness is the whole story. Short rates barely move when the market expects the Fed to hold. KRONOS is not predicting a crash here. It is predicting nothing happens, which, for the short end, is exactly the holding pattern, and the one that matters most. QQQ, the NASDAQ 100 ETF, at $731.07 today. KRONOS drops it to $625.68 in 30 days, minus 14.4%. The range runs $612.41 to $739.57. The market declared the hike dead at 24 cents. KRONOS is pricing a different problem. The expensive part of the market getting repriced lower. This is the AI's version of the momentum crash that already rattled July. The odds say hold. The model says the risk is still sitting on the growth side. Put all three on one screen. Long bonds, up 5.4. Short bonds, down 0.8. Growth, down 14.4. 1 bullish, 2 bearish. KRONOS is telling you the relief is selective. The safety trade wins, and the growth trade pays for it. That is the AI reading what the odds are trying to say, and saying it louder. So what comes after September? The October meeting, October 28th, carries roughly a 50% chance of any move at all. December, the last projections meeting of the year, sits near 63%. The September dot plot is the bridge between them. If the median dot points toward a cut in December, the September hold starts to look like the last hold for a while. If the dots point toward another hike, the market is mispriced today at 24 cents. Watch the dots. They are the roadmap. Here is what you do. Step 1. Stop watching the odds. 24% is not 0, and 75% is not 100. Build a plan that survives all three outcomes. Step 2. If you carry a card balance, pay it down before the September decision. A hike moves card rates within weeks. Step 3. If you are buying a home, 6.69 is high, but it is not a crisis, and waiting for a quarter point you cannot control rarely beats locking. Step 4. Move idle cash to a high-yield account. 3.7% beats the national average of about 0.4, and that gap is free money while rates hold. Step 5. Watch the dot plot, not the headline. The decision is the news. The projections are the actual roadmap. 5 steps, 1 meeting, and your money stays on the right side of the Fed. Every chart, every source, and the full breakdown of the September odds are in the description. The Fed meets in 30 days. The dot plot is coming. Subscribe for daily AI finance analysis, because the next rate signal drops before the meeting does. This video is for educational and entertainment purposes only. It is not financial advice. Past performance does not guarantee future results. Always do your own research before making investment decisions.